Rafas Mwanyasia, a research analyst with the Canon Capital, is a market analyst for the day. Many thanks for joining us. Now, on the back of what has just come in with Centum plans to acquire a 73% stake in Genesis, what's your thought into that? And it's a fund management company.
Well, I think it's been a long desire for Centum to diversify its product offering. It's essentially a private equity firm, so I think it's a natural step for them to go into the investment management side of business. And that has been the trend. Look, in the country for the last 6 months, we've seen 3 new players coming into that particular space. So I think it's an exciting investment place, considering the growth projections for the country and the increased number of listed companies at the bourse. So I think going forward, you're going to see more and more players coming into that space and more competition.
But looking at the core business for Centum, which is private equity, and we've seen a lot of interest in that particular area, and we've seen also a lot of companies that are also looking into Africa, particularly the East African region. How do you see the competitive landscape for Centum, especially looking at it at its core business?
I think it's just looking at it in terms of return. I think there's good return considering the economic projections. Looking at even in terms of diversification, because ideally the private equity business is centered on only 3 sectors of the country. You're talking of real estate and a bit of fast-moving goods side of sector. But I think with this new investment, it will allow them now to even have a more of a diversified program, because with it you'll find all sectors of the business represented. So I think in terms of diversification, it also allows them to kind of spread their business and even to add more value for their shareholders and even give more value even to their clients as well.
Talking of the diversified portfolio, Centum has got a stake in UAP, which has just announced the results, reporting a very flat growth of about 1% to about 498 million shillings. Is that impressive for you?
Not really impressive, but I'm not surprised, because the industry itself, the insurance, has been kind of a laggard compared to other financial sectors, and I think there's been a fundamental problem with the business itself, in the sense that there seems to be a problem with clicking with the market, and there's this constant number that is always told that insurance penetration is below 5% for as many years. I think there's need for more product innovations, more new thinking into how we can tap into the vast growth opportunities in the market. So I think the 1% growth in the profitability, not surprising but very low. I think the whole sector as a whole needs to just to kind of rethink its whole strategies.
Talking of growth strategy, we have seen that their operating expenses rose by 30%, and this is something that was actually seen across the industry in most of even the financial sector and insurance sector, whereby we're seeing the companies expanding regionally, and these have actually also shot up their expenses. For you, what's your take on that?
Well, that's given the fact that if you're expanding, then you expect your expenses to slightly tick up. I think, but also it's informed by the fact that some of their policies, expenses came from their policies that they're paying. So I guess because of that, we expected the expenses to come on the higher side.
Now, crossing over to East African Brewers, the second capitalized stock in the market, we have it shedding 3% yesterday to close up at about 298 shillings. And also on the back of that, we have news coming in that the excess duty on Senator Keg, which is their flagship brand for the low priced beer, will take effect on 1st of October. It was previously exempted from taxation, and now it will attack 50% in terms of that. For you, how do you see their performance going forward, especially on this flagship, one of their main volume movers?
I think it's going to have a big impact, especially on their sales. And that's going to be a big challenge for the new MD, considering the fact that they've had very sluggish sales even for the last 6 months. So I think that I see them just going back to the drawing board and finding ways on how to boost their sales.
Yeah. For you, what do you see is a key challenge that they're facing, besides, of course, the financing cost, which they're renegotiating to try and have better rates and terms and a longer duration?
I think the other challenge could be competition. And when I say competition, I don't have any particular play in mind. It's just that, you know, the fact that this product was meant for the low end, and if it's no longer there, and the guys will go straight back to the, drinking an illicit brew. So I think with that in mind, I think that's going to not only impact on their profitability and growth of their turnovers, but in terms of competition, they're missing out. So in terms of just driving the business going forward, I think perhaps I think they may be forced to pass on the cost to the consumer and hope that they'll still retain the numbers to consume the product.
Just to put that into perspective, when you talk about passing the cost to consumers, with the new excess duty of about 50% increase on our keg, it means that now for every liter, according to the company, that means an additional 35 shillings per liter, and that almost doubles the cost of that particular beer. For you, do you really see, especially since the target is the low end of the market, the bottom of the pyramid, do you really see them still partaking of this particular product?
Well, Senator Keg is it's good. There are going to be challenges there, considering also Senator Keg is a fairly new product in the market. It hasn't really quite got the loyalty like some of its premier brands. So I think, in my view, there's going to be some effect in terms of some of the guys that used to consume it, falling out. But I'm just thinking, with the financial muscle that they have, they could push the product in terms of more aggressive marketing, and perhaps maybe working on maybe cost-cutting measures, just to say how can we absorb the cost, or partly some of the cost, and maybe just pass on the cost, a bit of it to the consumer. So I guess there's going to be a delicate balancing act there.
The stock is currently trading at 298 shillings. For you, what's your fair value?
250 shillings, I think it's already quite close to its target price. I think right now it's just hitting a ceiling. That's why we've seen no movement really on the upside for that particular stock. So, with all these news that we could see a bit scaling down from the foreigner side, who've been the main buyers on that particular stock. If they start scaling down on their purchases, we could see the stock price start ticking down. Well, perhaps maybe to about 200 shillings. That's what I'm thinking.
So we'll be watching to see how the stock performs later in the day. Many thanks for joining us. That is Rufus Monyasia, investment analyst at Canon Capital.